Welcome to the latest Motley Fool Scoreboard. I'm on in Chocolate and we've got longtime fools Nick Sciple and Tyler Crowe giving a 1 to 10 rating to tech-savvy pipeline company Enbridge, ticker symbol ENB. I see Nick smirking. First, we'll rate the strength of Enbridge's business, including factors like industry and competition. A 10 is invincible. A 1 is hopeless. But that's it. Both of you give it an 8, right, Tyler?
Yeah, certainly on the industry factors and the business itself, because the business of moving oil and gas is about as stable as an industry you'll find, especially in commodities. You know, as long as a company in this industry doesn't over leverage or spend too much on, expansion, they will likely remain consistent for decades and produce generous long-term cash flows. A pipeline can throw off cash for 30 years with barely any investment whatsoever. Enbridge certainly has the assets to be one of those businesses. The only variability for U.S. investors, at least from from the business component, is the variability of currency fluctuations, which kind of come and go with the wash over the long term.
Yeah, I'll add to it what Tyler said just about the strength of the business model is that the assets, the pipelines that Enbridge has are systemically important to the North American economy. Move about 30% of the crude oil produced in North America, a substantial portion of that's produced in Western Canada. They transport about 20% of the natural gas consumed in the U.S., and they operate North America's largest natural gas utility by volume. Sells the stuff that it transports under take-or-pay contracts that provide certainty of cash flows. Think about David Gardner's snap test. If you snapped your fingers and these assets that Enbridge owns disappears, the U.S. economy would be impacted the very next day in a very negative way.
Follow-up question for either of you, right? Like on their website and everything, they're just always touting the tech savviness of their stuff, tech, just like any other company does AI for everything. Is that kind of a load of manure, or is it, versus other pipelines, or are they actually better at tech?
I'm going to defer to Nick because being a international investor, I'm not allowed to look at their website.
Yeah, listen, I think when you have assets that are largely undifferentiated from other folks in the space, you're always going to look for opportunities to differentiate yourself. I haven't seen anything from Enbridge that says, hey, they're super special from a tech perspective. There's obviously things you can do to reduce leakage in your natural gas pipelines and things like that. There's obviously opportunities there. I haven't seen anything from Enbridge that says they are doing something over and above what anybody else in the industry is doing.
And for those who missed what Tyler was saying, this morning he was trying to look at the site. He lives in the country of Georgia, and he was blocked. I could get to the stuff, but let's move on to management. A 10 is Warren Buffett. A 1 is Homer Simpson. Ooh, these are low. Nick's at a 2. Tyler, you're double his score at a 4.
Yeah, I was the generous one, but we're both going knives out on this one. I fear, and this is not just the current CEO, this has been a track record for Enbridge for the past 10, 15 years. I fear Enbridge management is more interested in empire building rather than growing shareholder value, which are two very different things. I think a great example of this was its recent deal to acquire Dominion Resources natural gas distribution pipelines in 2023. This is a low to no growth business that they said was a must-have asset, and they paid 16 times earnings for it. Last time I checked, if I'm buying a no growth asset, I'm not paying that much.
Yeah, I rated management a 2. We let off saying that the assets that Enbridge owns are systemically important in the type of business where cash flows are super dependable. It really just depends on management to manage those assets well. And I just don't think management has done that. The current CEO has been in the role since 2023. Prior to that was the chairman beginning in February 2017. So he's had some influence over the relevant period. During that time, the company has consistently paid out more than it's earned, both in dividends and capital expenditures, and it's used debt to make up the difference during that period. That current management has been involved with the company. Debt's up about 55%. The stock has trailed broader indexes and the energy sector on a total return basis. So that includes the dividend, which is the vast majority of the return. I just think the assets have been mismanaged, and other management teams could do better.
For financials, a 10 is a fortress. A 1 is yikes. For those hoping for higher scores, you're not going to get them. Nick's at a 2. Tyler, you're just at a 3.
Yeah, like we were saying, with the way that they've been managed with debt growth, Enbridge has been known to push the debt levels up to the precipice of discomfort for investors, and this is not the first time. It happened in the 2010s with a major acquisition, I think, of Sempra Energy, where its dividend very much looked in question, and management was able to pull it out by the skin of their teeth. But it hasn't ever cut its dividend during these times of financial strain. But its recent cash flows and balance sheet leave a lot to be desired, and should raise more questions for investors.
Yeah, I went with a 2 simply because Enbridge hasn't generated enough free cash flow to cover its dividend in just one of the past 5 years, while also using debt to increase to cover that difference. And in a world where the stock has done nothing over the past 5 years, all of the return of the business comes from the dividend. If the dividend is in question, then I think that the real investment thesis for the business as a whole is in question.
Put another way, for the last 5 years, free cash flow has not covered dividends. That gets a 2, right? Let's talk about valuation. Tyler, let's see if there's some light here. How well will Enbridge's stock do over the next 5 years? And how safe is it? A 10 is a sure thing. A 1 is a lottery ticket.
Well, sorry to disappoint on him, but I game with a 5-year of 0 to 5% with a safety score of 4. Like we've been kind of hinting at here, I think something looks a little off in its financials. And for example, the price it paid for those Dominion assets makes me wonder what management's motivations are for growing this business, whether it's to, make assets under management look really big or to actually drive shareholder value.
Yeah, so I decided to go provocative and say that it's going to be a money loser over the next 5 years. As I said earlier, if I look at the dividend, just optically doesn't look sustainable to me. And if the dividend gets cut, the stock is going to be a loser. Over the past 10 years, the stock is down 14%. All of Enbridge's returns have come from dividends. If you think the dividend can't be maintained at the current level, then the stock isn't going to be maintained at the current level either.
Right. So that was a safety score of 3 from Nick and less than 0% return. Right. Money loser. Well, top it should be easy then for both of you. Tyler, is there a company you like better than Enbridge?
Well, I mean, based on our comments, we could probably go in a lot of directions in the midstream space, but I'm going to pick, I think, as one of the best capital allocators in this business. It's MPLX. The name is the same as the ticker. It's been a stupendous capital allocator over the past several years. It's a subsidiary of Marathon Petroleum, manages it has a very conservative balance sheet and has not tried to stretch itself too much when it's actually gone out and done projects. Growth's been a little tepid lately, but it just has started to see some investments in natural gas pipelines that should start to boost the bottom line a little bit more. But with its dividend now, I think as we are talking, it's north of 8%. It doesn't take a lot of growth to generate full shareholder returns.
Yeah, I've said it before on this program. I'll say it again. Canadian Natural Resources is one of my favorite energy companies. Different type of energy exposure in Canada as compared to what you get from Enbridge. It's the largest oil producer in Canada, second largest natural gas producer in the country. Very different capital allocation. This is a company that defines free cash flow after they've already paid out the dividends. They don't even start kind of spending on these other projects until they've covered the dividends. Got a 4.9% free cash flow yield, dividend yield, has increased it for 20 straight years, has a clearly articulated capital allocation policy. I think it makes it among the safest energy companies to invest in. If you can invest internationally, another one that I think is worth paying attention to is Topaz Energy, ticker's TPZ on the Toronto Stock Exchange. It's a royalty business in Canada, so more similar to Enbridge in the sense of the safety of the assets. Basically, they get paid if production comes off of their royalty acreage. It's partnered with Tourmaline Energy, which is Canada's largest natural gas producer. It pays a healthy dividend, and I think it's going to increase over time.
Thank you to both Nick and to Tyler. They've given Enbridge a woefully low score of 3.8 out of 10. That's less than half of the 8.0 that would force me to own shares. Well, its business got an 8, and it was downhill from there. Look out for any Scoreboard every market day at 7 p.m. Eastern. Next up is CME Group, which I promise you will score much, much better. Till then, Fool on. I just forget, you know what I mean? Like, because we didn't travel anywhere. We just went to the Giant and loaded up and washed the food in the bathtub like geniuses. And